So let's talk about what's happening in these markets. I think what we've seen is perhaps equities fading the escalation risk when it comes to the geopolitics. But this is an equity market that is ultimately still trying to find its footing here, just given the confluence of news flow that we see right now.
Yeah, no, absolutely. I mean, I think looking at the geopolitics, there's been a lot of noise we've seen in the market here, which now we've seen, a bit more clarity on geopolitics. We've seen this market. You can't keep it down. It's coming back, and we've seen that strength leading Asia in the open today. If we think about what's driving markets, it is going to be earnings. This week in earnings, we've got half the value of the S&P reporting. And so that's going to set the tone. We at the Private Bank think we can see 6% earnings surprises coming into this in the numbers that are baked in. So we are positive. And so from that perspective, for us, earnings are front of mind.
Okay, so looking out for an earnings surprise here. And when it comes to the broader strategy, what are you telling clients right now? I know the long-term view has been geopolitical tensions, perhaps uncertainty around the Fed means portfolio diversification is the ultimate way to play the game here. But what feedback are you giving to clients in this environment?
Yeah, absolutely. I think there's been too much focus in the market around the timing of when we're going to see a rate cut. And so we've been telling clients that our view is that earnings are going to come through and drive returns. So from that perspective, we're about 2% overweight on our model portfolios for equity, but we wouldn't rule out fixed income here. We're seeing good quality investment grade bonds. Intermediate duration is paying just under 6%. So even though we can see ourselves dialing up equity as we get more clarity on how 24 and 25 is going to look, but at the same time, if you can lock in those rates now and manage that reinvestment risk at just below 6% for good credit quality bonds, we absolutely would recommend clients to do that.
You say there's been perhaps too much focus on the Fed timeline here. I think that's an interesting perspective because you're probably not wrong. But the losses that we saw last week, is that also a reflection of the repricing of expectations around Fed cuts moving forward?
Absolutely. I mean, all yielding assets had a tough time of it when you've seen that rates have stayed higher. And, the fact is that we aren't going to get that elixir of an early cut coming through in rates. So from our perspective, we know it's a matter of when, not if, cuts are going to come. Right. And so, on any sell-off we've seen in markets here, selectively, we do see this broadening out trade. You go out and pick up sectors that have been forgotten or oversold here to allow you to get to those sort of more optimal weightings in anticipation that when we do see, even though it should be baked in, when we do see that cut comes, we can anticipate that will be another sort of uptick in momentum we can expect from markets.
Okay, interesting. Toby, just before I let you go as well, a two-pronged question here. We've seen oil prices come down, but ultimately still quite elevated given historical norms. That's probably because of the geopolitical tension that we're seeing. What's the inflation risk as a result of prices just holding around this 90 USD handle?
I mean, CPI is on the front of everyone's mind. In our view, CPI is too much of a focus. It needs to be PCE come Friday. CPI's got about 40% shelter component, which we know is coming down, but it's lagging. It's also got about 20% of auto insurance quotes, which, because of the cost of repair was so high, is equally pushing that CPI number up. We expect CPI at the end of the year to drop to 2.5%, but the PCE is the best representation of the basket of goods that consumers are currently being hit with. Powell's focused on that, so we expect 2.7% year-on-year growth from the PCE. It was 2.8% at the last count. If that comes through, I think that's going to be quite a strong catalyst to sort of push towards a higher probability of a rate hike coming through.
Okay, bingo. Anything else? A rate cut. Anything else we should be watching ahead of the European Open?
Look, I think the main thing is at the moment it has to be I would say the AI themed trades that are coming through. We've got the big mega cap names coming through. The bar's very high for those guys to look to beat expectations. But I would start looking at not the AI enablers, but the AI adopters, these second tier of AI firms that are coming through, because the productivity gains that are going to come through, it will take time. But if we look at the market right now, we're relatively early in the AI theme. We can start, I think, seeing that performance we've seen in the mega cap tech cascading down to some of these smaller names.